Another day, another story. When reviewing a company's financial statements, here are more details to consider. Income statement. The income statement, also known as the profit and loss statement, provides a summary of a company's revenues, expenses, and net income over a specific period. Analyze the revenue sources, cost of goods sold, operating expenses, and taxes. This statement helps assess the company's profitability and its ability to generate consistent earnings. Balance sheet. The balance sheet presents the company's financial position at a specific point in time. It outlines the company's assets, liabilities, and shareholders' equity. Pay attention to key items such as cash, accounts receivable, inventory, long-term debt, and equity. The balance sheet provides insights into the company's financial health, liquidity, and solvency. Cash flow statement. The cash flow statement tracks the inflows and outflows of cash within a company during a specific period. It consists of 3 sections: operating activities, investing activities, and financing activities. Analyze the company's cash flow from operations, capital expenditures, and financing activities. Understanding the cash flow statement helps evaluate the company's ability to generate and manage cash. Financial ratios. Financial ratios provide additional insights into a company's financial performance and help compare it to industry peers. Some key ratios to consider include earnings per share, EPS. This ratio measures the company's profitability by dividing net earnings by the number of outstanding shares. It indicates the amount of earnings attributable to each share. Price-to-earnings ratio, PE ratio. The PE ratio compares the company's stock price to its earnings per share. It helps assess the market's valuation of the company's earnings potential. Return on equity, ROE. ROE measures the company's profitability relative to shareholders' equity. It indicates how effectively the company generates profits from its invested capital. Debt-to-equity ratio. This ratio compares a company's total debt to its shareholders' equity, reflecting its leverage and financial risk. It helps evaluate the company's solvency and ability to meet its debt obligations. Comparative analysis. Compare the company's financial statements with previous periods to identify trends and changes. Assess whether revenue and earnings are growing consistently, if there are changes in debt levels, and if the company is effectively managing its cash flow. Comparing financial statements over time provides a historical perspective and helps evaluate the company's performance. Industry benchmarks. Compare the company's financial ratios and performance to industry benchmarks and competitors. This analysis provides insights into the company's relative performance and helps identify areas of strength or weakness. Footnotes and disclosures. Pay attention to the footnotes and disclosures accompanying the financial statements. These provide additional information, accounting policies, and significant events that may impact the interpretation of the financial statements. Auditor's opinion. Consider the auditor's opinion, which is typically included in the financial statements. The auditor's opinion provides an independent assessment of the fairness and accuracy of the financial statements. By reviewing financial statements and analyzing key ratios, you can gain a deeper understanding of a company's financial health, profitability, and potential risks. It's important to interpret the financial statements in conjunction with other relevant information, such as industry trends and company-specific factors, to make informed investment decisions. Thanks for watching.